talk about the portfolio approach right now and how should you be approaching the market beyond trading. We have Sahil Kapoor of DSP Mutual Fund, the strategist there, and is joining us today to talk more about his latest report, Netra. I must say, I'm a regular reader of that report, Sahil. You know that, but what caught my attention in this note of yours was the last plate, and we'll start from there. The last plate talks about if the total invoice is $10,000 for tightening a screw, the actual tightening of screw costs only $1. The $9,999 is actually for knowing where to tighten the screw. So we know it's a bull market, right? But how to approach this bull market? That is the key. So tell us, how are you approaching this bull market? Is it showing signs of peaking out or not yet?
So, Ajay, I think one of the key themes is that since the last 2-3 years, since we bottomed out post-COVID, a lot of participants have tried to, micro time the market by looking at a few corrections and, trying to second guess whether the market will give a big correction or not. We haven't really seen a very large major correction play through. We had a correction in 22. And barring that, I think the last correction that we had when the market went from 18,600 to about 16,800 or so, barring that correction, we've had a fairly less volatile market as compared to many other markets in the aftermath of a very large run. So one thing is very clear that we are in a multi-year bull market. And we will have intermittent corrections, but I think the intensity of correction is going to be a guesswork that all of us will have to do time and again. So the best course of action, according to us, is to stick with this multi-year bull market. Of course, you can taper down your new investments. That means when you put a new rupee up, you should look at where the market is right now and try to stagger that purchase if the market is looking a little overbought or looking slightly away from its longer-term average valuations. In that case, you stagger your purchases, but I think we are still in a good, well-defined uptrend, and we should continue to hold steady with our equity allocations.
Fair point. What does the market breadth indicate to you? Because, Tata AMC stopped lump sum investments in small caps last week. Today, Nippon also came there and did the same. Some people are reading it as one of the signs that perhaps the broader markets pockets are getting frothy. Too much money is chasing that space, and probably these funds have taken the decision. I want to understand your view on the quality of earning versus valuation in the broader market, mid and small.
Sure. So first thing is that I think we spoke about market breadth. So what we did is we did an analysis. We went back in time and looked at when indices hit a new lifetime high, what can you judge from market breadth? Okay, so one of the indicators is, for example, if you look at NSE 500 as an index, and whenever you see more than 80 stocks or 16% of the overall index also making a new 52-week high, when the index is at a lifetime high, usually those life highs continue. That means markets don't see a very sharp reaction or a very sharp correction from those levels. Usually you see, intermittent corrections which are not very, very deep. I think this is possibly going to happen this time also, basis the data. Of course, market can, spring a surprise and do something dramatically different. But the history says, A, if you have good market breadth, usually the market should continue in a well-defined trend. And B, to change that, you need to see a deterioration in breadth. So you need to watch that. Secondly, second question about the market caps. So first thing is that when you do a pecking order globally, whether it is India or any other market, if you pick US, Eurozone, Japan, you will see that small caps globally are one of the cheapest across the board. And rightly so, because earnings growth has been much more dismal in small caps versus the large caps, and even for that matter, mid caps. But from a valuation perspective, for example, if you look at the US small cap index, it's trading at about 14.5 times forward earnings. In India, that number is slightly higher at about 17.5 times forward earnings. But these numbers are much lower than where the large caps are trading. For example, if you just do a comparative analysis where the top 7, the magnificent 7 stocks of Hang Seng are trading at 30 times multiple, and pick out the best small caps in US, they are trading at 15 times multiple. So I think that is the divergence in small and large cap stocks globally. In India, the multiples are not very extreme in comparison to, let's say, US, because India also had a small cap rally. But I think still there is, from a longer term perspective, from a 2 to 3 year perspective, there is still space for small caps to perform. From a short term timing perspective, I think yes, it makes a lot more sense when you look at the small cap category, because it's a more volatile cousin of the other part of the market. For example, if you look at historical data, small caps usually of the year see a 20% drawdown during the calendar year, and then usually they recover also. But this 20% drawdown could be a very difficult pill to swallow for a lot of investors. So it's always better to look at small caps either through a SIP format or staggered purchases, or increase your equity exposure in small caps when they have corrected. So I think that should be the approach. But I will not broad brush the category on the whole. I think there is still a lot of opportunity, specifically because domestic economy, where a lot of these smaller companies are focused, has just started to improve. I think those improvements have just started to come in. So if your horizon is sufficiently longer, more than 2 to 3 years, I think this is a category where you should continue to invest.
What about the first quarter earnings, first quarter updates, the quarterly updates which are pouring in so far? What are they telling you lies ahead in terms of quarterly earnings, the commentary and the numbers?
It's still too early to judge the quarterly numbers. We don't have the bellwethers also picking in, but the expectation is that we'll probably do a quarterly Q1Q growth of around 3.5-4%, which is the set for the course number for the full year. And FY24, we end up, with Nifty EPS between 950 to 980. Anybody's guess how fast or slow we do. But the key thing is that over the next 1 year, the expectation is that India is going to deliver anywhere between 12 to 15% earnings growth. And this number is a stronger number when you compare it to any other emerging market globally right now. So I think the real story is that there is an expectation of earnings growth that is coming through. Sectorally, I think it gets divided into a number of sectors which are, showcasing good growth trend. For example, a BFSI, or expectation that auto and other companies which are labeled as commodity users, they might see a margin improvement and therefore a better earning up going ahead. So I think commodity users possibly are going to see a bigger push in terms of margins and therefore better earnings profile. And plus, from a growth perspective, BFSI and some part of consumer stocks will make a comeback in terms of earnings. So I think the earning trajectory is fairly okay, fairly steady, and that should help the market overall during the earnings season as well.
Sahil, before I let you go, one last question on why do you find healthcare a very attractive area where risk rewards are much better than many others? And which part of healthcare? Hospital, diagnostics, US generic exporters, or domestic guys?
So particularly, I think the US generic business appears to be, in sort of a revival mode right now. We've seen there has been, a number of data points which has come in. For example, in US, there has been a lot of drug shortages, which has allowed the spoiling of prices, the price erosion trend to end. And we have seen that Indian US generic focused companies have started to gain market share. So this is sort of a double positive for some of these companies, which are gaining market share and also possibly going to see that they will be able to command a better pricing in US. Plus, I think the growth is also coming back for some of these companies. So I think that is the segment where there is a lot of promise. Secondly, when you look at the valuations for some of these companies on a comparative EV to EBITDA basis, if you were to do a pecking order of all the sectors in India, this sector has the highest margin of safety. So at one side, you see fundamental improvement in underlying business. Secondly, you also see that valuations are very attractive. So I think it's a good combination, at least for the next few years.
All right, Sahil, we'll let you go on that one. Thanks for joining us on the show.